Good afternoon. I'm Mario Becker, founder and CEO of Das Family Office, a Singapore-based fund manager and multifamily office. And in the following video, I'm summarizing the events of 2022 and provide a small outlook on 2023. I hope you're finding it useful. I hope you've had a great start to the new year. And if I look at financial markets in the first week, maybe this will be a better year than last year, because 2022 was a terrible year for all of us. Depending on how you're looking at it, 2022 was the worst market since 2008, the global financial crisis. And if you're looking at the global fixed income markets, it's probably been the worst year in maybe 100 years, or better say, the worst year in my lifetime and probably also your lifetime. The global bond index, Bloomberg Global Multiverse, lost about 15%. That's a number we've not seen before. If you look at global equity markets on a broad base, MSCI All Country World, that was down 15%, which is actually not so bad. It's disappointing, of course, but it's not a number like what we've seen in the global financial crisis, where this index was down more than 40%. The area in the equity market that did badly last year was especially technology, expressed in the Nasdaq 100 index. This index was down about 30%. And if you take a look at the equity market segments where investors were looking at companies that are not profitable, there are several investment banks that have published indices, non-profitable technology indices, and these are typically down more than 60%. Many of you are probably also familiar with ARKK, Cathy Wood's ETF, actively managed ETF, that's also down terribly. Also, private investors who tend to dabble with single stocks and bonds instead of following a more structured index investing approach, they tend to be down more than 30% because they often dabbled in the wrong names. They dabbled in digital assets, dabbled in popular names like Tesla, also Chinese names, Asian high yield. That's why overall 2022 was really a bad year. And let's hope that this won't be followed by a similar 2023, although I consider that highly unlikely. The reason was, if you ask me, of course there was Ukraine, but the biggest reason was obviously inflation, and the central banks were forced to raise interest rates very quickly in a very short time span, something that we hadn't seen since the late 1970s. And rising interest rates and shrinking market liquidity are always bad for global investors, and the most risky investments are typically suffering the most. That means stocks of companies that are not profitable basically imploded. If you look at long-dated bonds, be it government bonds or corporate bonds, they also sold off. Typically, 1% rise in interest rate means a 7% drop in a bond. And you can see that long-dated government bonds lost more than 30%. A number, again, that sounds hard to believe because we tend to put bonds in our portfolios for safety, for stability. And 2022 made pretty much all asset classes look bad, with the exception of energy stocks and certain commodities. Das Family Office is following a very structured investment approach. We tend to like index investing, be it broad-based, capital market-based indices or factor indices, and we're looking to combine building blocks, so-called safety building blocks, with return building blocks. And I would say this approach has worked very well again in 2022. On a certain level, we could call our clients relative winners in a terrible market environment, especially if I look at our standard portfolios 1 to 6, because all of them were really down much less than both bond and stock markets. And I think that investors in these portfolios should do much better very quickly. But of course, we also have clients who've been investing in the Nasdaq 100, who've been buying Asian high yield bonds, and they are equally disappointed. What's also been a big disappointment of 2022 were the investments in so-called quality stocks, which we like. We like managers like Fundsmith, we like Threadneedle, We like also their global small cap portfolios and European small cap portfolios. All of these have suffered a lot, and that was largely a function of them maybe being a little bit too expensive at the beginning of the year, but also the strongly rising interest rates. This should not be a similar problem in 2023, but of course these investments are also down significantly, and that's disappointing. So where do we stand now? What should we expect of 2023? If you know us family office, you will also know that we will not be presenting index levels that we expect to reach this year. We don't have a crystal ball, and we will never pretend we have. But what we do know is that investors deserve to get paid for saving, for working hard. And I can honestly say, if you follow a structured approach, if you're looking to buy sensible investments at the right price or at favorable prices, don't pay too much for accessing them, your long-term and medium-term investment goals can typically be reached. And based on that, we're now liking to look at where the various asset classes are trading at this point in time. What are their valuations against inflation expectations? What are their valuations against history? And this is very, very important, because if you look at last year, you could see at the beginning of last year, global government bonds were very expensive. So were technology stocks and also the stocks of smaller companies. We could have actually avoided some of the disappointments in 2022 had we taken an even closer look at valuations. We did that, of course, but we should have probably also taken into consideration that the Fed may have to raise interest rates faster, further. And I guess in that regard, we were a little bit too optimistic. We thought inflation may indeed be a little bit temporary, but now that wasn't the case. So if we're looking at the valuations early 2023 and compare those with medium to long-term inflation expectations, we can actually conclude that valuations are quite attractive. Medium to long-term inflation expectations for US dollar investors are between 2 and 3%. And if you compare this with short duration government bonds, corporate bonds, you can see that you can easily get 4 to 5, sometimes 6% for short-term government bonds and corporate bonds. So clearly there appears to be certain value, even if the Fed may have to raise interest rates even further in 2023. If we're looking at global equities, they also display equity risk premia that are above 7 to 9%. Traditionally, we expect 6 to 8% risk premia for equities. So there's also an indication that global equity markets are not too expensive. And that gives us the confidence that maybe the 60-40 portfolio, which is often being discussed and which is also reflected in our portfolio 4, should do quite well again. This portfolio has been criticized because bonds were so expensive, and people were thinking of alternatives to bonds in the 60-40 portfolio. But now I think we can say with confidence that this strategy should continue to work and shouldn't be doubted. What is also quite interesting, if you're looking at Asian bonds, be it corporate bonds, investment grade bonds, also high yield bonds, all of them show very high returns compared to the recent history. Obviously a function of the fact that Chinese property bonds did so badly in 2022, but it appears that there may be some value. So it may be worthwhile adding Asian bonds to the traditional portfolios. So in a nutshell, if you follow the structured approach which we advocate, we have developed a concept of so-called fair horizons. That means if you invest for the short term, be it up to 1 year, you should only stay in safe bonds. If you're looking to invest for 2 to 4 years, you should actually consider adding global equities to your bond allocation. And if you stretch it out further, 4 to 7 years, 7 to 10, 10 to 15 years, and more than 15 years, you should steadily increase your allocation to global quality equities. This is an approach that's not rocket science, that's widely used in the industry, but unfortunately not widely used among private clients. We would therefore encourage you become a little more institutional in your thinking, in your overall investment approach, reach out to us, and I'm sure you can improve your portfolios from where they are now, and then don't have to worry too much about them going forward. With this in mind, I'm wishing you all the best for 2023. May it be wonderful for you and your loved ones. May you be healthy, happy, and successful in whatever endeavor you're embarking on. Yours, Mario Becker.